Hi, everybody. Steven Sitkowski here. Welcome to this week's edition of Market Insights. Let's get to it. Hope everybody had an awesome week. Let's see what the week may hold in store for us. Quick reminder that everything we do here is for educational purposes only, should not be construed as investment advice. We can't do that. We don't know anything about you, so we have to speak in general terms, but there'll be a lot of usable information, I can assure you. When you're thinking about the market and you're thinking about investing, what should you be mindful of? Well, number one, the fundamental influences on the market. We'll talk about those. The overall market trend condition. How are the various sectors of the market performing? And so I'm going to give you some numbers for that. And then ultimately, you can look at stocks within those sectors. So that's kind of the checklist that we move through. So what's moving the market? Well, interest rates are on the rise. They've been creeping up the last couple of weeks. Last time Chairperson Powell made his announcement, did his press conference. I don't think he helped anything. It wasn't awful. They held interest rates, but they made it clear rates are going to be higher for longer. So I'm going to take them at their word on this. We have a potential government shutdown looming. We'll talk about what impact that could have on the market. We don't have any real market catalyst for the upside right now. Not until the next earnings season. That's a ways away. 10-year Treasury is up to 4.523. Oil sitting at 89.69. It's kind of stabilized around $90 a share. So what to watch this week? Nothing going on today. Tomorrow we have new home sales. We have the Case-Shiller Home Price Index, consumer confidence coming out. A little bit of Fed speak on Wednesday. Durable good orders. And then it starts to pick up a little bit. Thursdays, we always get initial jobless claims. We'll have a revision for GDP. They're expecting that to be revised upward to 2.3%. And again, a little more Fed speak. And then on Friday, a whole bunch of data: personal income, personal spending, personal consumption, expenditures. Friday could move the market. So that will be fun to watch. And we'll take a look at the charts here in a second. Last week's heat map was ugly. Look at the red. Tesla down 8%, Amazon almost 7%, Google almost 6%, Microsoft nearly 4%. One of the few bright spots, United Healthcare, which has been definitely on the move. So we're seeing some of the health-related companies doing a little better, but everything else was off last week. Now, year to date, there have been some tremendous winners. Google up 47%, Meta almost 150%, Tesla nearly 100%, Amazon 54%, Microsoft and Apple both plus 30%. So, if you're considering just a regular old stock portfolio, that'd be very reasonable to, if you picked well, to expect to be up 30, 40, 50% on the year. Now, if you didn't pick well, or your broker didn't pick well for you, you very well may be flat. So this has definitely been a stock picker's market, led by a handful of big names. Market breadth last week. Look at the advancers versus decliners on the New York Stock Exchange. That was not good. Look at the highs versus lows. 120 new highs, 303 new lows on the NYSE. On the NASDAQ, 161 new highs, 750 new lows. Yeah, definitely been heading south. Two of the big weekly losers both were the subject of cyber attacks the casinos. And then Moderna had a big week the week before, and then it gave it all back for whatever reason. So, the question is now what if the big seven, as evidenced in the green, versus the other 493 stocks in the S&P 500, what if these don't perform? They've been pulling back. Are we going to get some other leadership? That is what we're going to be looking for. Recession is the wild card. So, when the Fed raises rates for the last time, and I'm not sure they've done, but if there's no recession, markets go higher. If there is a recession, markets go lower. Right now, we're expecting a soft landing. At least I am. National debt's going crazy. And guess how much the government cares about it? Nothing. They don't care. It's not their money. It's not their debt. Most of those dudes are older than I am. So they're thinking, we'll let the kids and the grandkids worry about it. At some point, we're going to have to pay the piper. Do you realize we're paying almost $1 trillion a year in interest to service that debt? So what happens to the stock market during a government shutdown? Well, we haven't had them last very long, but the one that lasted the longest, 2018, look what the market did. It went up 9.3%. So it's not like there's some huge risk out there. I'm not changing any strategies personally. And frankly, I think sometimes the country would run better without the government. Auto manufacturing profits. Look at this. Tesla's making all the money. Say what you will about Elon Musk. That guy is a freaking genius. And even though Tesla has cut prices, they're making 15% this year. Ford's losing 1% and GM's making 6%. Here's our latest economic projections on GDP as of September for this year, 2.1%, 1.5%, then growing to 1.8% in 2025. But you know what? That is so far away. But that's where that sits. And this week is the worst week statistically in the stock market of the year. But after that, market screams higher. So we got some goodies to look forward to. And the Fed's not done. No. Latest dot plot shifted upward after the last Fed meeting. So I'm expecting one more rate increase. Year-to-date returns by sector, communication, technology, and discretionary, done really well. Industrials, energy, materials, not much. Boy, industrials and materials were making a move, and now they've sort of retreated. And then all of the defensive stocks, those sectors are down. Financials, healthcare, staples, REITs, and utilities. It's kind of like a cartoon where the character, there's a bomb threat. So they hide under something and then the bomb hits the something. That's kind of what's happened in the market this year. All right, let's take a look at the charts. See what's a cooking. Let's look at the SPX, which is the S&P 500. And what does this have to say? Well, you can see where we crossed below the 50-day moving average, crawled back up above it, crossed below, then it acted as a level of resistance, and we're still below. So, for the last 6 months, we're up, but look at how the 50-day moving average has rolled over, and we're trading below it. So at the moment, definitely more bearish than bullish. And I doubt we'll see anything different on the Qs. Yeah, same kind of a profile. So, seasonality is a big part of this. This is typically the time of the year where the market falls for a bit, but October, November, December, generally really good months overall. So we have that to look forward to. All right. I will see you all next week. Until then, stay blessed. Bye for now.